All right, we're going live in 5, 4, 3, 2, 1. Hello, everybody. Hey, welcome to a special capital gains tax solutions broadcast, webinar, podcast, kind of a mixture of all three, where we are bringing on Don Wenner with DLP Capital to talk about all things investing in multifamily lending. As a quick background for those who don't know me, my name is Brett Swarts. I'm founder of Capital Gains Tax Solutions, where we help people defer capital gains taxes on the exit of highly appreciated assets. And then once those taxes are deferred, we work with and strategically align with amazing commercial real estate operators, our favorite being multifamily, and one of the top groups we work with being DLP Capital. And so a lot of our clients, friends, and family have asked questions, especially given this time of change and market uncertainty as it pertains to the multifamily lending fund. So we're going to be focusing like a laser on that. For those that know who the multifamily lending fund is, Don is going to be kind of presenting and going an overview on that. But I want to welcome Don to the podcast, to the webinar. Don, would you share a little bit about your story and your focus right now with DLP Capital before we dive into the investing in the lending fund with DLP Capital?
Yeah, absolutely. Thanks, Brad. Thanks for having me on here today. Yes, my name is Don Wenner. I'm the founder and CEO of DLP Capital. Founded the company 17 plus years ago in Lehigh Valley, Pennsylvania, which is actually where I'm talking to you from today, although we are headquartered now in St. Augustine, Florida. And we've been investing in, income producing housing for 17 years now. We started off as a developer and operator, which we still do to this day. But then about 9 years ago, we launched our lending strategy, lending to other sponsors, operators who are investing in housing. That's multifamily, that's single family, some manufactured housing and RV, but housing, mainly workforce housing for, your proverbial teachers, social workers, police officers, nurses, people who in most parts of the country struggle to have housing that's affordable. They can afford their rents and not have to sacrifice education, healthcare, food, et cetera. And that's what we do. We've been doing so as a senior mortgage lender to full-time real estate investors since 2014, out of a fund we call the DLP lending fund. Today at DLP as a whole, we're about $5 billion of assets, 700 employees. We've grown 50% or more in revenue growth for 17 straight years. And pretty excited about what's ahead, even in this volatile market we're all in today.
Very well said, Don. And I think that that's a great introduction to, if someone might be considering the DLP lending fund and or considering, staying in and being, keeping a lot of their wealth in the lending fund. And that's what we're going to be touching on. So Don, let's start with the top, reasons someone, might be concerned. What are the top either objections and or false beliefs or just, concerns that people have as it pertains to the lending fund? And then let's kind of talk through that. And then let's show you're going to share your screen here after that. And we can kind of dive into the actual numbers and the data behind it and the performance and such. But what would you say, someone saying, hey, Don, I'm invested with you now, or I'm considering it, but I might be concerned. What comes to mind, would you say, Don, when for some of the hesitations someone might have?
Great question. I think the probably the biggest concern or perception is that property values are going to rapidly decline, and that just in general investing in the general term of real estate is going to be at risk, right? The property values are going to go down. I think that's the big overarching kind of concern people have today. And I think the people who maybe are a little bit more in tune and understand what we do as lending, construction, bridge, financing to real estate developers and operators, I think the next really big concern is, well, are they going to be able to get your loans paid off? Are they going to be able to sell the property or get permanent financing in this market? I think that's probably the second biggest concern, or maybe the biggest concern for those who have a little bit deeper knowledge of what we do. And
Excellent.
I'll
So
explain kind of the answers to or feedback to that. But
yeah, so let's talk through that, right?
yeah.
So I think that's a good point, right? It's from 2008 crash. We saw property values. It took about 3 years to go to the bottom in real estate. Different market, different shift for a lot of reasons. But what I love about the DLP lending fund is that I think the average loan to value on these first senior mortgage positions is about 55%, meaning there's about 45% of equity already built in. And so let's just imagine there's, 5 properties and $10 million worth of loans on 5 or 10 properties. The average equity on that on 10 million total value would be, 4.5 million. The loan is about 6.5 million. A lot of margin between where, in my mind, how I would see it, Don, is, the actual asset, if it was foreclosed on, right, and the value drops drastically, to actually have the investor start to lose the money, or walk through that so people understand that concept there.
Yeah, absolutely. Great lead in. So right now our average loan to value is to your point, Brett, 52%. So that means, to use real numbers or semi-real numbers. We have $1 billion of loans right now in the lending fund out against nearly $2 billion of real estate. And mainly that real estate is housing that is and remain affordable for the local workforce. So think of $1,000 a month, $1,200 a month, $1,500 a month rentals, mainly across the southern states in the United States. And so from a practical standpoint, the risk that property values are going to drop by 50%, and we're going to be upside down is a pretty extreme expectation, again, in affordable workforce housing. In Florida and Texas is our top 2 states. The expectation that's going to happen is hard to expect that to be at all practical, but because these are how the fundamental underlying assets are rental housing, and right now in this market, as we sit here today, rents are going up. Occupancies are at all-time highs. Delinquencies are at near all-time lows. The performance of the actual asset class is doing great. And a lot of the things that people are concerned about, such as the incredible growth in interest rates in the past year, are only forcing more people to be renters. Right now, we have the largest gap between what it costs to rent a house and what it costs to own a house right now in America since 2006. It's $1,376 more per month on average to own a home than to rent a home in the average market across the United States, meaning more people have no option but to rent. Even though rents have gone up a lot and are still going up, the cost of home ownership because of interest rates has gone up so much faster that more and more Americans are choosing to rent, or not having the choice, but to stay renters longer. So the fundamental performance of the asset class is great. So to go into that doomsday of, all right, property values were to drop 50% tomorrow and we had to foreclose on all of these properties. Well, if we did so, we would take back these properties at north of a 10 cap rate, meaning we could generate a 10% cash on cash return just off rent without any leverage, without any sales. We could generate 10% returns on a monthly basis. That's a really phenomenal place to be. To give you an idea, multifamily, single family housing has been trading at about a 4 cap rate for the last many years. So we're in a great position that if we did take back the properties, we could own them, operate them, and generate cash flow. And that's the other side of what DLP does. We own 18,000 units right now that we own and operate. So taking back the properties and operating them and managing them is something we do every day. But to give you an idea, we've done 5,000 loans over the last 9 years in this fund. We've never written off $1 of principal or interest on a single loan, let alone having all of our loans go bad, right? We haven't written off $1 of principal or interest on a single loan in 9+ years, 5,000 plus loans.
Yeah, let me just highlight a few of those things there. I think that's so A, incredible, and B, reassuring, right? Because if you did foreclose, essentially you'd own the property free and clear at that point. 8% cap rate, which you're right, properties are still at 4s and 5s. And these are workforce housing. And by affordable, it doesn't necessarily mean Section 8 or government subsidized. It typically means just conventional multifamily properties and better locations. It could be 80s, 90s, 2000s constructions, right? And these are actually performing assets as they stand today. But if the doomsday were to come, what you're saying, Don, is essentially, would you increase your cash on cash? I mean, because right now, I mean, how do you see that playing out? Let's imagine that, let's take $100 million worth of the billion goes bad. And by the way, also I'll touch on this too. When you have first positions, are there second positions behind that? Because it might be favorable for you as a first, but I guess you would wipe out the second, even if there were a second, or if they over leveraged or did some kind of side deal on this, right? Where they're getting themselves in trouble, outside of, what your loan documents call for. Think of the worst case scenario here, right? You foreclose on $100 million out of the, the $1 billion that you have loans on, you take them back. Has the investor lost a dollar yet? And, or can they potentially increase their position from what they're getting, which is averaging, 10 to 11% right now, for the return on DLP lending fund?
So to answer your question, no, the investor wouldn't have lost any money in that situation. To your point, just off of cash flow, we should be able to hit our historical returns and maybe greater, but we now also have the upside of having taken back this real estate at 50% of the value at the time of the loan. So the investors would actually share on the upside then, that as we generate cash flow and wait for the market to come back, which it always does, then we'd be able to sell for an increased profit on top of the cash flow, right? Which is the whole ownership side to our business, and how we generate in our equity fund a 28% return net to investors over the last 5 years annually. So no, there would be no losses. It'd be more upside, a lot of work on our end, but from an investor standpoint, you'd still be well sheltered. You'd still be able to get monthly distributions that we distribute every single month. We'd have even more upside and really no additional downside. We'd also now have some additional tax benefits. And so really the doomsday, or even though it's an extreme doomsday situation, isn't all that bad. And the way I think about it is, if we're in a world where property values get cut in half, you're going to have a lot bigger problems in other parts of your investment picture and portfolio than what you have in workforce housing, right? There's going to be, I can guarantee you the stock market and other investment strategies are going to be in quite not pretty position if property values get cut in half.
Yeah, very well said, Don. I think it's key. And by the way, you can learn more about Don Wenner by going to dlpcapital.com. DLPcapital.com, and they also have some really cool events that they put on. One of them actually will be a speaker in a breakout session coming up in November. It's called a Family Wealth Legacy event. I don't know if I'm pronouncing that correctly, right? But it's in St. Bonaventure Beach, Florida. And part of what I love about Don, the leadership team, and DLP Capital is it's more than just investments and returns, just making an impact for the community and making a difference in the world, especially as it pertains to housing and workforce housing and the housing crisis in America. And so back to that doomsday part of this, by the way, if you want to learn more about that conference, go to dlpcapital.com. Part of that doomsday scenario, better off. We'd all be better off. And by the way, my wife and I, we personally invest in DLP lending fund capital, right? And a lot of our clients do as well. And so, Don, you're saying you would actually be better off because we're going to get that tax benefit. We're going to get the opportunity for the appreciation. We're going to be at a 10%, which is, let's call it, perhaps a break even when it comes to the cash on cash. Not that we're hoping for that. But if it happened, at least the investor is protected. And then number two, you're right. The other opportunity or the other cost for where your investments would have been otherwise, whether it be in the stock market, whether it be in other assets that don't have the liquidity as much, right? You might be in a tougher position. Anything else you want to add to that or subtract?
No, I think that's great. And to reiterate, what we do in this fund is we provide first position financing with full personal guarantees as well. So not only do we have the collateral of the real estate that we have a first mortgage on, we also have a full personal guarantee by our borrower. And our average borrower has a net worth of over $5 million. Our average borrower owns and controls more than $50 million of real estate. Our average borrower has 40 plus employees. Our average borrower has low 700s credit score. So these are professional full-time operators who know what they're doing and are, again, personally guaranteeing that loan. And we can all argue, well, if we're in a doomsday scenario, and how much is that personal guarantee worth? Maybe it's not worth a lot, but in a normal environment, having them personally on the hook is a big deal. So the doomsday that we've been spending a few minutes talking about isn't practical, but it's always good to know, all right, what's the worst case scenario, and to know that the worst case scenario isn't all that bad is I think reassuring. The practical day-to-day, real challenge we have as a construction lender, as a bridge lender, is almost all of our loans, the way we get paid off, the way we get our money returned, is the borrower refinances into a permanent loan. And the good news is, even though a lot of the banks are out of the market today or aren't lending much due to some of the banking crisis that have gone on, the main source of takeout financing in our industry is agency, Fannie, Freddie, HUD, and they're doing really, really well. The government's put a lot of money behind allocations to them to be able to continue to originate loans. Those loans are 30-year amortization, or HUD are actually 40-year amortization loans, fixed interest rates for 7 to 12 years. Right now, even though rates have gone up a lot, those rates are still in the 5s to low 6s. Because the rates are now in the 5s to low 6s, generally the takeout financing ends up being more like 65% loan to value instead of 75% loan to value like it was maybe a year ago. But considering our average loan is only 52% loan to value, most of our borrowers are still in a really good position that they can refinance, pay off our loan, and get a permanent loan in the 5s or 6 rates. And we had over $200 million of loans pay off in Q1. We're on track to have even more here in Q2. So it's taking a lot more work, but our borrowers know what they're doing. They're successfully executing on their business plans. They're getting us paid off, allowing us to recycle that capital. But it's certainly a little bit harder today than it was a year and a half ago when lending was easier. But that's why it's so important we lend to high quality borrowers, so important that we have a lot of cash invested, so important that we have a low loan to value. And we've been working through it, as well as it could have ever hoped for.
Excellent, Don. So we've covered the property values and the doomsday scenario. I think we've overcome that one. I feel really great about that. And then also, are the loans going to be paid off? It sounds like that's not so bad either. I mean, yes, were they at 3.5%, 4%, and are they now at 5.5 to 6? Yes, that's huge. That's a huge increase, right? Yeah. But the takeout financing of 65% LTV versus 75, right? It's 10%. It's not as doomsday as people might think, of all these, banks shutting down or not lending. Right. And you have to realize that, Fannie and Freddie and HUD, the housing is the most important thing, when it comes to financing for the government to provide housing rebuild. That's it's so foundational to everything that we're about, especially affordable housing. So they're behind it. So, okay. So that's what else comes to mind? So someone might say, okay, I feel good about that, Don. What else comes to mind if someone might want to, if they're or considering investing, that, oh man, I'm just not so certain. Maybe it's an emotional thing, right? I know for some of my clients that we have invested with DLP Capital. Sometimes it's not the performance; everything is good. It's just like, maybe maybe I have more there than I can feel comfortable with, and it's more of an emotional thing. So, any emotional arguments or thoughts there, or objections that you could think about that you face, that you could help people to feel really great. And I think you mentioned a couple things. You guys are professional operators, so you're lending to professional operators. You have 18,000 units, so you could take over. You're integrated with, you have the 700 employees, and your business plan is set there. In other words, and you're also helping others build elite organizations and build the multifamily operations, right? So you're doing it on every part of the scale there. But anything else to add to that, Don? You see what I'm getting at here?
Yeah. I mean, I think, and I can, cover then, kind of the real highlights to why, we think the not only the strategy that we operate, but the way we structure the investments so attractive in this market environment and frankly in all market environments. But I think the kind of biggest challenge per se that investors have, maybe to kind of where you were initially going, is what we are dealing more with is people having concerns of, well, I have a lot of other asset classes, a lot of other managers per se that are not performing, where I'm losing money, or I'm having capital calls, or distributions have stopped, and people sort of taking from I'll call the winners and to fund the losers. And you even look at, like, it's been a lot of big public news about, Blackstone and BlackRock and the stopping the redemptions, right? Putting up the gates on redemptions on their BREIT. Well, the fundamental thing that I think is kind of funny that I don't think most people realize is the reason they had all these big redemptions is because all their institutional investors, these big pension funds and endowments, looked and said, all right, well, the BREIT value has gone up and all my other investments in the stock market have gone down. So now I'm overweighted to real estate. So now we need to reduce our real estate exposure to get it in line with the assets that aren't performing. So let's take our money away from the winners and let's put more money into asset classes that aren't performing so that it fits the model that we allocate under, right? And I'm oversimplifying slightly, but that's largely what happened. And that's why all of a sudden groups like CalPERS came to them and said, oh, we've got to redeem $1 billion because we have too much now in real estate because our public equities went down 30%, right? And that's why they had this kind of issue. And we all, and that sounds so silly when we sit here and hear something like that, but we as humans, emotional humans, can do the same thing, where it's like, oh, well, now I have a lot of assets in multifamily or in housing, and I need to come up with cash over here. My investments went down here, so I'm going to reallocate money in order to solve that. Or, hey, it's something that's not doing well, I need to put more money into it, so I'm going to go put more money over here to something that's not producing cash flow and isn't performing, because I want to, I don't want to get devalued, or I don't want to get my position reduced when it's a loser, right? Or at least right now it appears to be. And I'm being a little harsh, but we see that happen, right? So we're seeing people dealing with problems in other aspects of their portfolio. Or we see similarly people kind of listen to the news and they hear, oh, commercial real estate is at risk, and there's all these banks and all these groups with this exposure to commercial real estate. But commercial real estate isn't all the same. Office buildings in Manhattan is a very different investment than, Class B multifamily housing in Florida. Those are not at all similar asset classes. And so a lot of the groups who are dealing with commercial real estate problem is they're over allocated to office, to retail. They're over allocated to markets like San Francisco and New York. What we're invested in is housing that is and remain affordable to working families, predominantly in the Sun Belt, places where there's job growth and population growth. Very different than high-rise office buildings in New York. And they kind of gets grouped together in media as if that's one thing or if they're similar. And they're absolutely extremely, extremely different.
I think you hit it right on the head right there. That is exactly, I think, what's happening emotionally and even just financially. And I like how you put that larger scale to show how it's happening on the larger scale. With the endowments and with the BlackRocks and such, that the real estate's still performing, you're doing really well, but the fundamentals have changed on their allocation that they had to fit into their box there, right? And so they're having these capital calls because the equities have dropped, 10, 20, 30%. And now they're saying, well, we better pull from to try to, reallocate in a way that's balanced the way that they define that. And I think I think you're right. We do that personally. And I think the other part of it too is sometimes we don't want to take the loss. Like, we don't want to admit that we're the loser, or we invested in something that was the loser, right? I think that's putting a little bit harsh too, Don, right? Sometimes it's a pride thing, right? You're like, gosh, well, if I don't sell that stock, it could come back, Don, or if I don't sell that piece of real estate, it could come back. I have enough time. And
Yeah.
so sometimes it's a pride thing of knowing when to get in, when to get out. And if I can live off and just kind of allocate from over here. So any thoughts on, and maybe, when have you learned in the past to not invest in that deal or say no, right? How do you stay disciplined on keeping how you invest with allocations in general? I'm just curious, what's the mindset there?
Yeah, and I'll answer kind of first part of just we all do that where we don't want to take the loss, right? We don't want to lose money, that principled nature, so we've all been there a number of times, and I'll give a simple example. I've had many cases over the years, especially back coming out of the last cycle, when there was so much fear back in 2008, 2009, 2010. So many people went out and bought, I'll just call, terrible annuities. And so a lot of investors locking in 2%, 3% kind of annuity products, right? And to get out of those annuities, once people kind of realized kind of what they did in a lot of cases and realized I just locked up my money for a really low return, especially when they factored in the fees associated. I've seen annuities that are 1.25% kind of returns after you remove all the fees. And I've had many conversations with people struggling, saying, well, to get out of this annuity, I'm gonna have to pay this 10 or 8 or 7% penalty to get out, right? And I've seen many people not be able to accept that, right? So instead, they stay in an annuity for 10 years, earning 1.25%, costing themselves, in comparison to say something like the DLP lending fund, costing themselves literally 10% a year to save 8% over 10 years, right? And I've literally had to run that analysis. Some people say, all right, you have 500 grand annuity right now. You're going to make 50 grand over the next 10 years. Or you pay the 8% penalty today, and you're going to earn 50 grand a year, and earn 500,000 over the next 10 years. And really the factor of compounding returns, it ends up being, earning $1 million over the next 10 years. Right. And if you can take that step back and look at it, it's like, wow, it's so obvious, right? That obviously you just should take the loss now, get out of that bad decision, and know, hey, I can make that money up in a year's time off the returns on a better investment, right? And so I've seen many people be able to come to that rational decision and come to that conclusion in that example. And I've seen many people, even though all the math is so obvious, still not able to do so, just because we're all so principled that we don't want to ever lose money. So for me, it's hard, right? When we get into decisions, when you make personal, emotional decisions, it gets hard to do that at times. But I've learned the hard way, and I've learned the value of money, right? And when you're in markets where you don't have a good places that you can put your money and get good returns, the formula is different. But I filter everything against the DLP lending fund. I filter all my decisions, say, all right, if I let money sit in this property or in this investment, and the cost to me is earning 10, 11% a year, that I get the money sitting in the lending fund, that I know it's going to earn that return. There's no question in my mind about it. And so letting something sit, waiting for it to come around, knowing I'm giving up 10, 11% returns, that helps me filter and run the simple math behind things. And in many cases, then make what feels a decision, a very easy decision, to get out of a loser.
Very well said, Don. I want to apply that now to an actual live deal that having this conversation. Fortunately, it's not an annuity. It's actually a multifamily property. It's in California. It's for a client of mine, and for him, it's the cost of to sell the asset, so the brokerage fees, right? And it's the cost of the prepayment penalty, right? And in comparison, LP lending fund can do and increase the cash flow. So his ROE, his return on equity right now, is around 4 to 5%, but his interest rate is set. It has a cap on it, but it's set to expire in about 12 to 18 months, and which means he's going to drop his cash flow by another $5,000. His total valuation of the properties about $5.5 million. The debt after debt and closing cost, commissions, 2.6 million would hit the deferred sales trust. We would defer somewhere around $1.2 million, $1.3 million in tax, right? So looking at all these different numbers, and for him, he's going, but it's going to cost me all this money to get out, right? And it's like, well, that's one way to look at it, but and then it was the break-even analysis of, well, how long would it take for you to make up those fees that you paid, and then what will your picture be like in 24, 36 months going forward. And so talk about it from the perspective of a multifamily owner, and that, what would you say to that person there? Maybe it's the same thing you just said for the annuities, but any thoughts on that?
Yeah, I'll just say, specifically to all of our funds, but specifically to the lending fund, people choosing to exit real estate, especially, choosing to exit, assets where you have a very low basis, is where so much of our capital has come in over the years, and people realizing, all right, I'm in this asset that I've owned for 5 years, 10 years, 20 years. And being able to exit that asset today and get out of, number one, the management, the operations, the work necessary. And for many of our investors, that's a big part of the equations. They don't want to do that work. They don't want their children or their wife or husband, most commonly kind of their wife, to have to take over dealing with that piece of real estate, if he's no longer here, is another factor often. But then looking at, all right, putting aside even the work side of it, saying, all right, I'm only earning 4 or 5% really on my money right now in this piece of real estate, with all the risk, with the volatility, with the work. And when you can go and exit a property and go into something that's producing double digits, distributions monthly, very little volatility, and with the deferred sale to be able to completely defer out those gains. It's an incredible kind of aha, I think, for a lot of people. And I'd say, probably 20% of the capital we have, 25% of the capital we have is in those situations of somebody exited, the money was in real estate. They exited from managing a piece of real estate, operating it, getting generally low returns, and now move that money into our funds. And it's not only, generating much higher returns, but also taking away the risk, the liability, the work. And we've seen that again and again. And it's been the difference for many people being able to fully retire, or being able to really, vacation the way they wanted, or so many other, significant life changes we've seen time and time again.
Amazing. Yeah. And by the way, if you want to learn more about that, you can go to capitalgainstaxers.com about how to exit your business or real estate to your cryptocurrency, primary home, defer the capital gains tax, and then to be able to turn around and all tax deferred, be able to invest into a DLP lending fund and be able to get those returns, but all tax deferred. Go to capitalgainstaxers.com. Promise everybody that you would share your screen. And so I don't want to live up to that promise. So if you want to share your screen and maybe walk through some visual numbers and some data there from everything we've been talking about, and take it away. Yeah.
So I'll hit on just a few things. And this is just a presentation I was telling Brett that, we put together, over a month ago. Every quarter. So in our lending fund and all of our funds, every month we produce full reporting, everything you could ever want to know about the fund, the assets, what we're doing. And then every quarter we do a full webinar just on that fund, going into depth of what's going on. So these are some snapshots, some slides from that presentation, and we provide all this to all of our investors. They can see all the historical reporting and whatnot. So anyway, I'm just going to give a little bit of highlight of, this is a few weeks old now, but a little bit of the highlights of our lending strategy here briefly. So this is just the quick, for anybody who's not familiar with it, this is the quick overview to the fund. 8% preferred return. We distribute that out on the first of every month. And that 8% preferred return is paid before we even get a management fee. Targets to get 9 to 10% net to investors. We pay out 2 distributions a month. So the preferred return on the first of every month, and then all the other income middle of the month. And we do all of this in a mortgage pool private REIT, which means 1099 tax reporting. And we do so with liquidity. So it's 90-day liquidity, even though it's a private fund. So 90-day liquidity, double-digit returns, 2 distributions a month. That's the really high level of what we do. And to kind of some of the notes, 52% loan to value we talked about earlier, significant equity invested. We can take in qualified and non-qualified accounts, work with a lot of clients of Brett's coming through the deferred sale. We get the benefit of unlimited qualified business income deduction. So instead of being taxed at 37%, you're taxed at 29%, if assuming you're at the highest tax bracket. This is a fund we were running for 9 years, audited financials by Cohen Resnick every year. This is our historical performance. So this is the annualized returns distributed monthly, double digits every single month, for 9 straight years. We just passed a couple weeks ago, it was a pretty cool milestone. We just passed $1 billion or $100 million. We just passed $1 billion in size. And we just passed $100 million in distributions to investors this past month, which was pretty cool. 100 million of profits distributed to investors, which was pretty awesome. So I'll just hit on a couple other, quick notes here. So every month we give a report of every loan that paid off, how it paid off, where it was located. We give a report every month of every loan we originated, all the details on it, overall stats. We give case studies and examples of some of the loans we've done. So this is an example of a loan we closed in November. It was a brand new property in Idaho, and the borrower, though, when they had to close on this property, but it wasn't yet stable. It was only about 70% occupied. So we gave them a loan in November, and they then got it stabilized, meaning they got it fully occupied, and refinanced this out into permanent debt in March of this year. So it was only a 5-month loan, 64% loan to value. They came to the table with $13 million of cash. We generated a 17% return on this as a lender. Give you a little feel. So here's some of the pictures and some of the overview of this property. This is the sponsor. I'm kind of going backwards through the slide deck, but this is the sponsor, Whitney, who owns about $400 million worth of real estate. Phenomenal guy, phenomenal Christian, runs a great business. One of our elite members, we're helping him scale his company, who we made this loan to. So these loans are 6 to 18 month loans, on average paying off in about a year, typically being paid off when they go into permanent debt. So that's the super quick kind of highlights. Couple other quick notes. These are the strats. We produce this every single month. You'll see communities. And then the rest are on single family properties, or in some cases, land that's going to become a rental community. So that's the quick overview. I can hit on more there, Brett, but that's just to give a little bit of feel for those who aren't familiar about what we've been talking about, what the fund is, what we do, how it works. And then kind of last summer, I know I said it earlier, but I think it's worth repeating. We've been doing this for 9+ years, running this fund, this exact fund, double digits every single month, 5,000 loans, haven't written off $1 of principal or interest on one loan, not a single loan, in 5,000 loans. So great, consistent track record, and through multiple cycles, through COVID, through this environments, through low rate environments, through higher rate environments. And we're making loans to professional operators who know what they're doing, who are looking to buy distressed real estate. So volatility and distress in the market's a good thing. That's what we're looking for. We're looking for guys who are going to buy properties at a better deal. We're going to give them low leverage loan to fundamentally really solid assets, i.e. workforce housing that's affordable for the local working families.
Amazing. Don Wenner, I want to thank you for being on the podcast webinar kind of presentation here. I want to thank you for your leadership and your consistency and your performance with DLP Capital and making an impact. I want to encourage you to keep doing that and keep helping more and more people get workforce housing and invest and to dream, live, and prosper. That's what DLP Capital stands for, Dream, Live, Prosper. You can learn more about Don by going to dlpcapital.com. And so I also want to thank everyone else for attending and listening to this episode here. And I want to encourage you, if you have any exit plan needs at all, you can go to capitalgainstaxsolutions.com. We can help you eliminate the need for 1031 exchange, defer your capital gains tax, and invest with proven operators and funds like DLP Capital. Thank you so much for watching. Please share this with someone who can be an encouragement to, and we will talk